But let's get back in the markets here. Very heavy morning for earnings. Let's bring in Christopher Grisanti. He's the chief equity strategist at MAI Capital. Chris, always good to see you here. Let's start on earnings. It's been an interesting morning. Disappointing quarter from JPMorgan. Sent a warning, I would say, on the consumer. But then you have Delta noting a really strong rebound in corporate travel demand. As someone trading this market, which report should you put more stock in?
Well, Brian, it's nice to be with you again. I think that, first of all, I didn't think JPMorgan was that bad once you kind of factor out the losses caused directly or indirectly by the war in Ukraine, and including a big nickel loss caused by commodity fluctuation. So it's kind of an aberrant quarter. I think Delta shows that the reopening trade is part of the mix. But I like to say it's a Jerry Maguire market. Companies have to show you the money. And clearly, Bed Bath & Beyond did not. JPMorgan.
Yeah, they didn't show any money, Chris. No money over there at Bed Bath & Beyond. Nothing.
Money. In fact, they showed a lack thereof, my friend. So I think that retail and other value stocks have really been taking it on the chin as the economy is essentially slowing a bit. And it's going back to an economy that you need to see growing cash flows. And that leads me to think, wow, growth may have a resurgence from its recent kind of clobbering. So.
Christopher, it's still early days here in this first quarter earnings season. I'm wondering, as you look ahead, what sectors, what industries, what individual names even should investors really be focusing on, since we've had a number of strategists coming out and saying that if you are a short-term investor looking for some tactical opportunities, earnings season does tend to present some good opportunities.
Yeah, Emily, I think that's a great question. And what we're focusing on now is a group of stocks in lots of different sectors that we're calling post-COVID hangover stocks. So things as different as Home Depot and Domino's Pizza and even Amazon, which did absolutely terrifically during the pandemic. They saw their revenues grow multiples faster than they otherwise would have grown. Now, all of a sudden, their same-store sales or comparable measures are relatively flat. So investors think, oh, they've lost their mojo, but they haven't. They're just consolidating really terrific gains. They're not shrinking. They're still growing, but slower. So we like those three stocks as opportunities for investors to get back in the program. All three of those are trading significantly below their average valuations in a relatively expensive market.
Oh, I like what you mentioned there with Home Depot. I mean, the stock has really pulled back here, Chris, on mortgage rate increase concerns. But really, look at the fundamentals of Home Depot compared to the disaster that is Bed Bath & Beyond. It's just a night and day situation. But I do want to zoom in on what you mentioned about Amazon. You don't sound concerned about the sell-off in big tech stocks.
Well, nobody likes to have a stock at X and then a stock at 10% less of X. But I would say, obviously, the fundamentals are what is important in the long term. And Amazon, folks don't realize this, Amazon makes more money now from services than they do from selling stuff that gets delivered to your house. Amazon Web Services, advertising, Amazon Prime, and that stuff is terrifically high margin. It's growing not by 5 or 10%, but by 20, 30, 40% a year. And so, sure, there can be consolidation phases like we're in right now, but I view those as opportunities. And it's a lot easier than making and delivering an electric vehicle car.
And when we think about the macroeconomic backdrop, of course, JPMorgan Chase CEO Jamie Dimon struck a cautiously optimistic tone while highlighting some of the risks to the outlook. Where are you placing the recession odds, the probability of recession in the next 12 to 24 months?
It's a great question because I think that matters a lot right now. And I would say we are more optimistic than I'm feeling the consensus is. We'd say recession over the next 12 to 24 months, about 25%. So, that's a meaningful number, but that also says more likely than not, we're not going to have a recession. There's some bargains out there, and you should feel a little more comfortable deploying new cash.
Really helpful insights here this morning. Christopher Grisanti, Chief Equity Strategist at MAI Capital. Have a good rest of the week.